It's Tuesday at noon, and that can only mean that Tech Trader will be joining us. And here he is right now. Good morning or good afternoon, depending on where you are. Sean, what's up?
Good midday, Mr. Jim.
Hey, good midday to you, my friend. So you started out with a pretty good day with Acacia, but before we get into Acacia and Cisco, let's get into where you think the NASDAQ is. We've kind of been messing around, flirting with the all-time highs a little bit. Do you think we're poised for another breakout?
I've been talking about. I made that one correction call. We had a 5-6% correction, maybe even a little more. And then I kind of felt like, look, I thought indices and averages in the market in general could go higher. What I didn't, I thought the cloud bubble was toppy before, and what I thought would elicit much higher market prices would be a rotational trade. I thought oils would pick up and go higher. I thought value would pick up and go higher, value tech, other spaces. There's a ton of room for a lot of stocks to go up a lot. I haven't seen, I generally hate biotechs, as we've talked about many times. But I will buy them, and I will invest in them from time to time. Honestly, I don't know if I can recall a time that biotech has traded this poorly in a market that appears being the key word, that appears this strong. But that's the problem. The problem is the market's not strong. It's the same 10 stocks go up every day, or 15 or whatever. It's, again, we've replaced the FANG bubble with the cloud bubble. A lot of these cloud stocks have very heavy market caps. By the way, remind me to talk about IGV later. Somebody asked a question about IGV. But the bottom line is you just sort of have this perma bid, perma buy, algo front running, retail buying of the hottest of the hot names. So the market actually could go up a lot if we had more than 10 stocks participating. And what is going to be the thing that gets other stocks participating? I actually think that the catalyst is pretty clear. I think a little bit of Fed, but I think the biggest thing is just you get the foot off the neck of the Chinese trade deal. The Chinese trade deal has so much embedded fear in it that a stock like LITE is actually down today on Acacia getting bought out. So that's a perfect testament to just the lunacy of the market. This is literally one of the stupidest markets I've ever seen. I've seen some of the all-time stupidest markets in my life, but this might be the dumbest. In many ways, I think this market's actually stupider than 1999, and we can talk about that later, particular reasons. But sentiment remains relatively subdued, and the reason for that is because not very many stocks are really participating. So indices are elevated. The level of indices look high. Charts look toppy. But if we get a rotational trade, look at the first 2-3 months of this year. Market was very strong with very good breadth, very good participation. We didn't really have the cloud bubble yet. Cloud bubble kind of really got going after Q2 earnings. So yeah, a lot of the cloud stocks bounced hard in Q1 off good reports, but there was tons of stuff that was going up. And there's really been, two things. China trade heated up, Huawei blacklist. So that killed a bunch of hardware stocks, short term. And I'm trying to think, oil's been very weird too. Same thing, like I just said. I don't know if I've ever seen biotech stocks trade this poorly with indices this elevated. I could probably say the same thing about oil. I don't know if I've ever seen oil stocks trade this poorly with the price of oil being this firm. And oil, 55, 60 looks like it's going higher. Yeah, oil stocks can't catch a bid. Or if they catch a bid, after they decline 30% and then they bounce 10 or something like that. So it's a very weird kind of like, it's just dumb. It's just dumb. The value seems to have that nobody wants to do any analysis on value. Nobody thinks balance sheets are worth anything. Nobody thinks a sustainable company with lower growth is worth anything. The only things that seem to be worth anything are hyper growth stocks, which is funny because hyper growth stocks have a huge risk, which is hyper growth turns into so-so growth. And when hyper growth stocks become so-so growth stocks, the stock prices drop massively. In fact, many times those companies become value stocks. I own a couple of those value stocks right now. So anyway, but the market's just sort of strange. I mean, it's really hard to peg the market with sort of much precision because a lot of the things that typically work, honestly, right now are not really working. But some of the typical clues that I always think work, sentiment always works. Doesn't work day to day, but it always, I mean, again, sentiment was a huge clue. I was pounding the table on an earlier correction this year. Yeah, maybe it took a couple weeks, boom, then it hit pretty hard. But yeah, like I say, sentiment is the best thing about the market probably is how pent up hundreds of stocks are, maybe even thousands of stocks, but how pent up hundreds of stocks are, how cheap. I mean, look at the move on Pi. I mean, little Pi, little, Internet of Things play, how hated was this stock from 13, 15, 16 bucks, things doubled. And I would say Pi has really had a great quarter yet. They've just sort of had better than worst feared type quarters. So that's the setup that you have for lots of companies. If they kind of got the China exposure done, or they kind of got trade fear stuff kind of priced in, if they've cut numbers enough, or maybe analysts have cut numbers too much, and then they just don't miss. I mean, I think a lot of people forget about Twitter's first double. Twitter's first double didn't have anything to do with revenue reacceleration, which I predicted, but Twitter's first double had everything to do with, they just quit missing. In fact, that was my first thesis on Twitter was, look, it'll be just like Yelp and Zillow. All Yelp and Zillow had to do to double and triple was they just quit missing numbers. So they basically met or slightly beat numbers for 2 or 3 quarters, and the stocks doubled or more. And that's exactly what Twitter did. So Twitter quit missing numbers. That was the first double. That was the 13 to 26 move. So, I mean, there's a lot of stocks set up to do that. So the market is risky, though. I'm going to say two things which seem counterintuitive, but they're not. I've said every time we've been on the air this year, I don't think we've hit cycle highs for the indices at all. I think the market can print much higher numbers, but I've also said we need a rotation. I don't think we can go a lot higher if only 9 stocks or 10 stocks are going up, and the thousands of stocks are not participating. So we need a rotation. We need broader participation. And frankly, we need money to come out of the cloud bubble so it can be reallocated to other things. So, but when that cloud bubble cracks, I doubt things are going to magically rotate and markets won't go down for days or weeks. So you probably need a correction to set up the next leg higher. That's probably, in fact, that's probably about 90% odds that happens. Whatever next correction occurs will probably be the thing that is needed to set up the next major leg of a market move higher.
What's to say we haven't already had that, and what propels the market higher would be the fear of missing out trade, which is what I think sets up to be the next leg higher.
Isn't that kind of what's keeping? I mean, it could happen that way. But I don't know. I just don't know if this year's correction was big enough. The end of last year's correction was massive. That's part of the reason that we just have had so few stocks go up. I mean, you could be right, and I mean, in one way, you're kind of saying what I just said, just differently. But it depends how it all unfolds, I guess. But hey, what if there's more M&A? I mean, there's a lot of really cheap stocks, and the one thing I always say is, value tends to pay accounts, and people that chase Momo tend to break their accounts. That's something I've learned. I've dealt with, talked to hundreds, maybe thousands of traders in my time. Never really met anybody who's written me and said, "Oh my God, I'm so glad I became, a hyper-aggressive momentum IBD trader and turned $400,000 into $4 million bucks." I know a lot of people though that have accumulated a lot of wealth over time that buy value. So, not to say momentum trading, momentum investing can't work, but It's just dangerous. There are times it works really. I mean, hey, there have been times I've largely been a momentum trader. When groups of stocks that I like, that I think are cheap on a relative basis, but other people think they're expensive. For example, Splunk and Workday. Everybody thought those stocks were expensive post their IPO. Like, they thought Splunk was super expensive at $28 because it was like 20 times sales. I thought Splunk was dirt cheap at 28. It went to 100. Then it corrected. It went to like the 40, 50 range in spring of 2014. I momentum traded the crap out of it. Same with Workday. Same with Now. Same with a bunch of those stocks of that era. But there are times when those kind of stocks set up really well on relative valuation metrics. Those stocks were exceedingly attractive on relative valuation metrics post-IPO and then after the spring 2014 correction. Things like MDB and Paycom and again, the cloud bubble list I have, which is 15, 20 names, they're not anywhere near the setup that they were in 2013 to 14, 15. Just not the same. Facebook had a huge, my old firm. Well, the old firm I participated, I wrote content for and had launched my first service with. We had a big debate. 12 of us weighed in on Facebook, the prospects for Facebook. It wasn't quite at lows yet. It was probably like 30 at the time, 30, 35. So I even said, yeah, Facebook probably goes lower, but I think it's going to be a monster company. Out of 12 people that wrote commentary on that stock, I was the only one who was bullish on Facebook back then. Only one. Everybody else was bearish on it. Because everybody else was practicing recency bias and worried about the stock going down the next $5. They weren't thinking about what the potential of the company was long term. So the bottom line is, again, I momentum traded the crap out of Facebook for years, for probably 3 years or more. So again, that set up very well. I mean, at $20, Facebook was 5 times net cash. Then at $40, it still was cheap on relative growth metrics. At $60, it was still cheap on relative. I mean, frankly, I probably missed 80 points or more on Facebook. But when you get triple quad, it's hard to be wrong. But the bottom line is these kind of valuations are the highest valuations we've seen since '99. So, hey, could they go higher? Sure, stuff went higher in '99. It didn't last that long, though. So, we'll see. We'll see where things are. I don't think things can remain this elevated with something correcting that level of lunacy. That's just my personal view. I mean, here's the thing. I know I will be right eventually. What I don't know is, can a crowd go to 100 times sales from 60 times sales? I'm using rough terms here, but can a Zoom go to 150 times sales from, I think the peak, Zoom peaked at like 72 times sales. It's dropped a decent amount of sense. Can they trade at 150 times sales? Yeah, stuff traded 150 times sales in '99. But you know what? They didn't stay there very long. And man, the other side of where they ended up, they didn't hang on to any of that valuation. I mean, at one time, Cisco Systems was 45, 50 times sales. Didn't hang on to that valuation. And once it lost that valuation, it's never returned to that point. So, that is what's going to happen. I mean, stocks like Crowd and IMDb and Paycom and Vive, et cetera, they're going to get hit and they're going to get extremely hard and they may never trade back to prices like these again. I just don't know when that's going to happen.
All right, well, let's move into the big news for today, and that is ACIA, and they are to be acquired by Cisco for, let me see, what was that? What was the takeout price? 70, right?
70.
So this one is actually not trading 70. It's trading, as soon as my chart loads up, it's trading around the $65.
65. I'll help you out. 65.
Yeah, so it's trading around the $65 area. So there's like $5 worth of upside. Now, the question is, do you take your money off the table now, or are you going to wait for this one to settle out? I guess the risk here is that China stymies the deal, and there's some type of restriction that China may have on this deal that may cause it to be a hiccup or whatnot. So I guess that's where the risk lies. But what are your thoughts? Are you selling ACIA now, or are you holding out?
Haven't sold any yet, but I will sell most of it probably fairly soon. I will keep some. So there's a ton of things we could say about this. So I'll try to go quick. So first of all, I'm going to keep some. There's a chance of maybe a higher bidder coming. It's a low probability. So, frankly, the company's worth a lot more than 70. This is just like Mule being bought by CRM. CRM bought one of the best cloud stocks, period, for a very attractive price. I mean, just think what Mule would be trading for today. My God, that just hurts to think about. But Acacia is arguably probably the best mid-cap, small-cap stock in the optics space. It just is. They got the best R&D. They got the best technology. They got the fastest speeds. The global leader in silicon photonics. Remind me about silicon photonics because I think that's a key part of this deal. The global leader in silicon photonics, they got a 1 to a 2, maybe even a 3-year lead in certain key technologies, blah, blah, blah. Cisco's buying the best name, and they're not paying that much for it. I mean, the stock was $60 not that long ago off the back of a good quarter. So, maybe there's, this is what happens to these companies, small mid-cap stocks now. They just get beat on. They literally succumb to stock market pressure. And it's sort of sad to see, but hey, whatever. This is what I'm going to do. I'm going to keep hunting for stocks like this and get good paydays, and I'll take them and move on. But yeah, I'm going to sell anywhere from 2/3 to 3/4 of this. I'm working on a list of what I'm going to put my money into. This is a pretty big payday for me. Baidu will definitely get some of this money. I probably will keep some of it in the 5G space. In fact, I'll probably keep the bulk of the funds in the 5G space. I just haven't figured out exactly what names I'm going to go after. I would love to buy another leading silicon photonics vendor. Guess what? There really aren't any. I mean, that's the thing. I mean, I got to dig now because even stuff that supplies silicon photonics could be a big deal. I don't think most people realize how big of a deal this actually is from a futures technology roadmap standpoint. This is a massive deal. I mean, here's the other thing I'd say. I really, really wish Cisco was cheaper. If Cisco is cheaper, I'd probably put the funds into Cisco. Cisco at $56 doesn't excite me that much. I mean, there's upside there. It could be a good grinder going forward. But I don't see Cisco going to 80 or 90 or $100. And everything I'm looking at right now definitely has 50, 100, 200% potential. So, I'm going to swap Acacia to things I think have 50, 100, 200% potential. Cisco have to do a lot of work to get to like 65, $70. And, what's that, 20%, 20, 25%. But this is big for Cisco. This is a home run deal for Cisco. But yeah, so I'm just going to work on lists, figure out where to put the Acacia funds into. I mean, most people probably guess names. I mean, I'll look at LITE, IIVI, MTSI, things like that. Maybe I'll sprinkle in a little more Infinera. Sort of amazing. Infinera is actually, let me look. It's okay. It was actually trading down on this. Now, some people might think this is a threat. Yeah, I mean, Infinera has been having to battle Acacia and Cisco for pretty much their whole existence. So I don't think this really changes anything. Honestly, the funniest thing looking at this, there's very little pin action. I mean, again, if the market wasn't so stupid, I mean, this is just a stupid market we're in right now. If the market wasn't so stupid, there would be 10, 5, 10, even 20% plus type pin action off this deal, which there should be. But there really isn't. But, Infinera, maybe people think the risks are higher. I think it's about the same. Infinera might be one of the last names with significant silicon photonics IP that at least from the vendor side. I'm not sure if Juniper Networks has much. They're not really in the photonics space, the networking, routing, stuff like that. I might look at Juniper a little bit. But bottom line, good deal for Acacia. They're taking the payday. I mean, my target was 80. They get bought out for 70. But, my targets are conservative. I really did think this stock could trade quite a bit higher over time. Yeah, we'll see what happens. I mean, it's good. It's solid. I'm not going to begrudge the deal, but it does feel a little bit like Mule. It feels a little bit like FNSR being bought out, too. I mean, I think FNSR would have traded way higher on their own. Although now with the Huawei blacklist and the China trade, FNSR probably would have struggled. And I haven't had a deal with FNSR struggling, so that's kind of been nice. But I think this is more like Mule. I think this is more Cisco really getting a gem and not paying a gem price. I think it's as clear as that. But yeah, fire away with anything else. But I do think there's plenty of other attractive. Put this way, I'm not going to have a hard time finding a spot for the funds, because there's a ton of stuff I think is very attractive, and I might even increase my short book too. I'm pretty comfortable with my shorts, but I might increase my shorts a little bit more, because this is a pretty good fulfillment and a pretty sizable position for me.
So explain to everybody, just so that it's clear, you do officially think that it's a good deal for Cisco, but you're not interested.
No, I think it's a great deal. I think it's a great deal for Cisco. It's not a good deal. It's an amazingly great deal for Cisco.
Okay, but you have no interest in getting involved in the Cisco, and tell everyone why.
It's $56. I mean, if it was 40, I'd probably be all over it. I just think a lot. Cisco is not a bubble name. It's not a bubble valuation. But I think the last time I was long Cisco was in the low mid-20s in 2016, and it's more of a grinder. I mean, again, hey, I'm more comfortable just simply taking more risk. So if I was somebody and running $3 billion, would I have would Cisco be one of my longs? Maybe, but still maybe not. I don't know. I just don't. I just don't think it's got a ton of upside relative to a lot of. I mean, honestly, I'd rather buy Juniper. I think Juniper Network sets up a very, very attractive valuation. I think Juniper's actually set up. I think they got a lot of untapped value and a lot of their intellectual property. I think Juniper needs to do deals. I think Juniper does the right deal. You can see the stock go up a lot. Juniper reminds me a ton of NetApp. That's NTAP, Network Appliance. So years ago, everybody hated NetApp, and it was like a $20, $25 stock, something like that. And so same kind of deal. Funny thing happened. Some activists kind of got a hold of it. They became a little more consistent on a reporting standpoint, which basically meant they just got numbers low enough. They kept guidance low enough. They kind of became one of these low guide but beat the current quarter over and over and over names. And stock basically, I guess it almost quadrupled off of lows. But Juniper has that kind of potential. So I'd rather, and you know me, dude. I'm always hunting for relative valuation. Cisco doesn't really set up super attractively on relative valuation. CommScope, which is a small position of mine, although I have been building it, kind of building Comm with trading gains. I'd much rather own CommScope. That might appear more risky to others, but to me it's less risky. I mean, I'd rather have a stock that's gone from 40 to 15 and accumulate that than have a stock that's gone from 25 to 56. Cisco's gone from 25 to 56. Comm's gone from 43 to 15. No brainer. No brainer. I don't care if I make money every day. I don't care if my account moves with the indices. Those are all things that other people care about that inhibit producing alpha, which is excess return. So, I care about catching things like Acacia. So I'm basically going to hunt for the next Acacia. Cisco is not the next Acacia. So I'm going to take maybe a little more. In some ways, though, I think I'm taking less risk because, again, to me, Cisco was really less risky at cheaper prices. The higher it goes, the more risk it contains. Hey, it's probably, let me answer it this way. It's probably $8 from a price that I would say, you know what, this is such a good deal. I'm willing to buy it, even though I think Cisco is kind of boring and stodgy and kind of a grinder. At XYZ price, I think this is a significantly good enough deal. It maybe can increase the time frame at which Cisco could pay out. So about $48. $48, and you never know. I mean, Cisco has a bad quarter. Cisco, has a little bit of a slump. They have a misstep or two or something. Yeah, would be inconceivable. I mean, stock was 40 in December. It was 51. Not in one of the corrections this year. It was 51. So I don't know. Yeah, $48. $48, I'd probably be pretty attracted to it. I just think there's lots of better names. There's just so many more names I could buy that has so much untapped value. They're just beaten and beaten and beaten, and there's just too many opportunities, frankly. So I don't really need. If I want my money safe, I'll just go to cash. You know, I don't. That's not really one of the things I'm really that interested in is buying ultra safe stocks. If I want safety, I'll go to cash. Otherwise, I'll take the risk of being in the market and being in stocks.
So bottom line, Cisco is just not sexy enough for you.
I guess. I mean, but you know, I do like mega cap stocks. If like Qualcomm, when Qualcomm was 51, I was all over it, as you know. By the way, even Qualcomm at 76, I'd probably favor, you know, pretty massively over Cisco. Baidu, no. I mean, why would I put money in Cisco when I could just buy more Baidu at 114? A stock I believe is worth 250, 300 long term. So they're just it's really it's not sexy. It's just if I thought if my price target on Cisco was 110, I'd buy it. But I just don't think there's a ton of upside from where the stock is right here.
All right. Are you thinking about rolling in some of those funds into AAOI at these levels?
Yeah, I could. I had talked about AOI a little bit. You know, more of a spec position. It doesn't have the quality of Acacia. It sort of has the volatility of Acacia without sort of the leading edge global R&D footprint, if you will. Again, Acacia is definitely leader. I mean, they literally had key technologies with a 1 to a 2, maybe even a 3-year lead in some cases. AOI is more of a niche, you know, data center, optics. But I will say this, everybody keeps worrying about the 100G sales for AOI. Guys, those have been gone for a long time. I mean, you know, analysts are still talking about, you know, Facebook losing the face. I mean, the Facebook business was lost 6 months ago. So I don't know what these guys are paying attention to. The fact of the matter is AOI probably sets up as a pretty good 400G data center play because they basically, you know, they're moving from 100G to 400G. They have a good 400G product pipeline. But yeah, I will probably add to that a little. It's kind of a tough trader. I do find it attractive on a valuation perspective, but yeah, I don't mind it. I'll probably moderately increase my position. I mean, the names that will most likely garner love. I mean, again, I love LITE every time it goes down. It's just the stupidest thing in the world that LITE was actually down today. It's climbed back. I probably should have bought some when it was down. My buy on LITE is just no coincidence, but 48 is kind of where I'm kind of hoping to buy it again. And as we've talked about, I was buying it really, really well a couple times this year, just recently, and then earlier this year in the low 40s. So yeah, LITE, IIVI. It's probably worth talking about IIVI just for a minute. So one thing that is missed in there's all these complexities in this photonics food chain. One of the things that's really important in certain photonics are materials, components, materials, but actually the actual materials that are used. IIVI, one of the important things they do is they're actually a materials processor. So without getting too wonky, think about, so if you want to build a chip, okay, chips go into photonics stuff, okay? But what do you use to make the chip itself? You need chemicals. You know, you need clean rooms. You need Amcor's technology, which is packaging technology. So, you know, how do you fit more stuff on a chip? You know, but you need substrates. You need materials. You need, I don't know if I pronounce it, you need idanium phosphide, and you need gallium arsenide, and da-da-da-da-da. IIVI is probably one of the global leading materials processors. Very strong. They've acquired private companies, small public companies in that space. So they kind of provide a lot of the building blocks that are used in photonics, lasers, things like that. Again, they're basically stole FNSR. Hey, maybe some people are going to worry about merger integration. I hope they do. Again, the stock's very cheap. So you know, once you run out of silicon photonics vendors, what are people going to look for now? Maybe suppliers to silicon photonics vendors. So yeah, I mean, I think IIVI would be likely to garner more funds for me. I probably have kind of enough of it, but what the hell? I might just overweight the damn thing. So because here's the thing I want to do. I want to keep my 5G total net exposure roughly the same. And if I unload a bunch of Acacia, that's a lot of my exposure to the group. So MTSI could garner some funds. That's actually having a good day today. MTSI, IIVI, LITE probably be the three names that get most of my Acacia money. And AOI might get a little. There's one other one I talk about from time to time. I don't know, the name kind of escapes me right now, but there's a couple other smaller players in the space as well. CommScope probably going to get a little bit of this money too. Although CommScope, I'm probably just going to keep buying it with trading gains, kind of keep chipping away at it with trading gains over time. INFR might get a little bit of it. INFR is just it's a weird, dicey chip name. You and I have talked, or not chip. Again, they're in the space vendor. The systems on a chip, PIC technology, so photonics in chip. So again, they're basically the only other company kind of like Acacia now that's publicly traded. So I don't know. I mean, the funny thing for Infinera, you've talked about this, is like you like the chart or something on it. They're having a hard time making it go much lower. I probably like the chart better than I like the company, but this company, I do think, has potential. It's feast or famine. They're going to have to hit some quarters, but they didn't guide the full year materially lower. They had a bad quarter, but they did not guide the full year numbers materially lower. If they come close to hitting their full year numbers, I think that the stock could work pretty well. But now I'm wondering, shit, excuse my language, who's gonna buy Infinera? I mean, I do think this. I mean, this is the name I'm probably the most shocked that's not up 10% plus today, because Infinera basically it'd be a very, very. I mean, what's the market cap on it? It'd be a super cheap buyout. I mean, if I was Juniper, I'd just buy them. I mean, it's $500 million. So you put a decent premium on it, even 100% premium. You're not paying much, and you're not. I mean, it's trading at like 0.5 times sales. So you get the money back in sales and cash flow probably relatively quickly. So I don't know. That's a name that is just. But these things just trade tough. In a world of no uptick rule and algorithmic front running, a stock like Infinera has a hard time. They're going to have to produce a materially decent catalyst for the stock to go up. But if they produce a materially decent catalyst, this thing could really go. But it's a small cat. You know me. I typically, just like biotechs, don't really like them. Penny stocks, I don't really like them. I will make myself buy them from time to time, but I put a limited amount of funds in names like these. I view them like a long-term leap. So my view on a long-term leap is a lot of the value of it could go away. So I only put what I'm comfortable kind of losing, 50% of or more. And when it pays pretty good. So Infinera could have an explosive move higher. I am surprised the stock's not up today. I think the theory might be that, this makes it a tougher competitor. Oh boy, but it doesn't really. No, they're already competing with Acacia, and they're already competing with Cisco. If anything, it might be a little easier to compete because Cisco kind of has a history of buying technologies and maybe not getting everything out of them. I mean, because what's going to happen with some of the leading people at Acacia? They'll do their 1 to 2 year stint, whatever their work contract is. Then they'll go out, and they'll start their own company again, and they'll start competing against Cisco in the future. It's exactly what what some of the folks I think they were once part of Juniper that went out and created their own company. Now that's called Palo Alto Networks. So, it came from NetScaler. So Juniper bought NetScaler. The guys from NetScaler, after their 2 year stint, basically went out and created Palo Alto. So, that stuff happens all the time in the world of technology.
All right. Any new updates on Ciena, CIEN?
Well, now that is one. If there's a stock, now they are up today. If there's a stock that this amps up the risk for them a little, I would say this is it. Now, again, same thing. They're already competing with Acacia. They're already competing with Cisco. I mean, CIEN's been competing with Cisco for like 20-some years. It doesn't really change things that much for them. However, it does put a lot of silicon photonics technology in the hands of one of the strong. So Cisco was probably, I guess I'd call them a weak number 2 or a strong number 3 in silicon photonics technology. Acacia's number 1. And I would say Cisco is clearly number one global leader in silicon photonics now. CIEN's a silicon photonics provider. They're not strong in that space though. Maybe CIEN should take a look at FNSR. But the bottom line is, I think if there's a reason CIEN now might trade a little sluggish, it kind of seems to me that CIEN probably maybe needs to either strengthen their R&D or maybe buy some assets or something like that. And it's had such a good run and reporting so well that, if you're a shareholder of CIEN, you probably don't want to see them do a deal. But I don't know. I mean, again, to me, the deal should highlight the value of all these companies. But what it doesn't seem to be, there's no pin action. I mean, it's just funny. MTSI has pretty good pin action. But even MTSI wasn't even, you could buy the thing flat this morning. It wasn't even trading up. It didn't even gap up. So, CIEN, I generally think this deal highlights the value that's inherent in the group. That's very underappreciated. And again, CIEN's been competing with Acacia. They've been competing with CIEN or Cisco for 20 years. Don't really think this changes much for them. But yeah. It probably amps up. It probably has them thinking that they might have to do something though. Might change their stride a little bit. But yeah, I mean we'll see. The two companies. I am praying MTSI does not get bought out. That is, if there's one name that I do not want to get bought out is MTSI. I'm literally getting worried that MTSI might succumb to kind of again a deal that other people might like, but I would almost guarantee you I would think it would be too low. So I really hope that doesn't happen. I hope they get their quarters back on track and the stock kind of does its own thing because they're set up very well with a lot of 5G assets. I also think their last release, I've had a couple conversations with their IR department. It's not, it's the head of their IR. He's a good dude. I used to talk to him at Skyworks years ago. But I think their last release on the data center business was largely misunderstood. They're not exiting the business. They're exiting a small part of the business. That wasn't really a very big part of their revenue. That's a name I still like. A very, very interesting space. I'll be excited when FNSR no longer trades. IIVI fully integrates FNSR. And then the next catalyst for them, I'm going to say, is really as we start ramping into the 2020 sales for the iPhone 3D sensing. And you could get a pretty magical thing happen. And this is a year away, but let's assume we'll probably have a China deal by then. Huawei's probably not as severely blacklisted as they are right now. Again, they're not as severely blacklisted as they were 3 weeks ago, but they're still blacklisted. But that unfolds. You get more sales into China. You get 3D sensing ramping up. You could get a really good cycle for IIVI. You probably got a couple quarters that are kind of squishy between now and then. But once you get into late this year, early next year, I think the setup for them looks super good, especially with FNSR integration and all FNSR's 3D sensing technology. But yeah, we'll see what happens. Like I say, it kind of saddens me. I really wanted to see Acacia, ride the 5G. So again, are we even in inning 1 of 5G? I'm not sure we're really. I would say we were maybe kind of in it or in inning 1 or getting close to it. And then Huawei got blacklisted. And that basically delayed. It was like a rain delay. so we're still kind of waiting for inning 1 to really get going. I don't know. It's selling in inning 1 of a very powerful upgrade cycle. Are you going to get the best price? I don't think so. I think now selling inning 9 probably isn't great either. Although selling inning 9 probably is great if you can get somebody to buy you. But the best time to sell is probably ending 5, 6, or 7. So Acacia, man, they're selling early. I don't know. It's just like Mule. Just like Mule. Hey, I'll take the deal. I'll take the gain. I'll take the payout. But yeah, I would have liked to see them stay solo for at least another full year. I think they could have garnered much more money a year or two from now. Put it that way.
All right, so the last thing that we'll talk about is IGV, and that's one of the things that you wanted me to remind you about, so
Yeah.
talk about it.
Okay, so IGV, somebody asked, is there a better cloud software ETF to look for shorting? I mean, honestly, I've looked. He said something about, he mentioned one. I'll have to look at that. The one he mentioned, I can't even recall right now, but I don't remember ever seeing it before. I don't like, I want liquidity, so I either want a decent net asset value or liquidity in the ETF. If something's real small, I'm probably going to shy away from it. I'm looking this up right now. Okay, so he was a Global X Cloud Computing ETF is the one he had looked at.
Do you have a ticker on that?
The names, yeah, CLOU. CLOU. I do like these names for sure. So let's compare these two. So you've got Plan, Coop, Shop, ZS, Paycom, Zero, never heard, DBX, DBX, dumb name to have in there, Workday, Twilio, Akamai. But they're all like 5% positions. So top 10 is 43.89% of the assets. I mean, that's not bad. I do like the valuation of a lot of those names. Again, there's a couple in there that again, DBX probably shouldn't even be in there. If it's targeted as the most expensive cloud stock. Now let's look at IGV. Now IGV is, one thing I like, the top 10 represent 57%, so it's a larger weighting. So Adobe, Oracle, Microsoft, CRM, Intuit, Now, Activision, Autodesk, Red Hat, Workday. Red Hat's going to get out of there. The interesting thing about this, yes, the top 10 represent 56, but most of that really is in the first 5 names. The bottom 5 are all like 3% names. So the bottom 5 on this list are especially the bottom 4 are only 12% of the fund. The top 6 have a lot more. Honestly, Adobe, aside from Oracle, I love all these names as shorts. The difference is, will these names drop as much if the cloud bubble really cracks as like the most expensive stuff, like a ZS? Probably not, but these names are just as egregious. So, Adobe, Microsoft, CRM, Intuit, Now, Autodesk, they're all, to me, they're all ripe for, a mini cataclysm if this thing unfolds the way I think it could. By the way, I mean, we saw a good precursor of this. So I guess I would tell that gent to go back and look at how these stocks did from September to December, the bottom in December. So if you find, and I don't even know if that one cloud ETF, I don't even know. No, I show the first day of trading on that was in April. So there's not really much of a comparison. Again, that could be good. You gotta. I do like those names, but I still like IGV, and the reason I like IGV is in some ways an Adobe might even be more expensive than something like a Zscaler. And that might sound weird, but it's not, because the growth rate's a lot lower. The stock has just gone up and up and up and up. And, again, once they crack, they crack. And IGV was a pretty good, I was pretty glad I had that short into year end. It did give up a lot of value. So, it definitely did what it was supposed to do, which is go down with the group. Honestly, I think they're both fine. If he likes the CLOU, that Cloud X one, I do like that list of names. I mean, it's got more of the most expensive names in it, specifically Plan, Cube, ZS, Paycom. Twilio's in it as well. So and Shop. So yeah, I honestly I think either one of them works, frankly. But yeah, that one might be almost better if you're trying to target the most egregiously expensive names. But I still think IGV does its job.
All right, and just to be clear, you like that as a short as opposed to saying you like it and then being in favor of that one of going higher, correct?
Yes, yes, I would. I wouldn't play either of these. I mean, the only way I would play these long is if I thought, Zscaler and Coop and Paycom and all these stocks were cheap on relative valuation metrics, and I don't. So, I mean, we've seen a lot of phases like this. I mean, there have been a lot of times. I mean, spring of 2014, there was a mini cloud bubble. I mean, how many times have we seen a group of stocks get extremely hot and persist in that hotness for a long time? Whether it was FANG, whether it's clouds, whether it was cryptos, whether it was, AI stocks. I mean, the market just seems to like to create bubbles, and then people seem to want to believe in them, and then they unwind. They unwind. But yeah, I think that I'm kind of glad he wrote that question. I'm gonna watch this cloud trade and kind of see how it acts. The only thing you got to be careful of, it really is liquidity, because sometimes they just don't trade like they should. In other words, let's say you have a day where all these stocks are down, I don't know, 5%. What if this thing's only down 2? I mean, we've seen weird things like that. So, you have to see how it acts, have to see how it trades. You have to see if it's liquid enough. I mean, the volume on a day like today, it's only traded 148,000 shares. That's pretty damn thin. Let's look at IGV. IGV's at least traded another 100,000. The thing about IGV, though, it can support a lot of volume. I've seen that thing trade, huge amounts of shares and trade pretty efficiently. So, it's got net assets of 2.6 billion. The other one's about 450 million. Again, 2.6 billion is quite a bit more assets behind it. But yeah, no, I think either one. I think they both look good as potential shorts. So I think he found a good name. That's good. It wouldn't make sense that I hadn't heard of it, because it just incepted in April of this year. And I'm not big. I don't follow a ton of ETFs. I don't look at a ton of them. It's not it's not part of what I do to find what new ETFs are trading. I think there's a new 5G ETF too. I think I'm only looked at it one time, and I didn't think the names in it were actually very representative of the 5G space as I see it. But I've literally only looked at that one time. I've never even watched a trade. So, like I say, I don't tend to track ETFs that closely.
All right, Tech T, I think that does a good job of wrapping things up for today. We've got earnings season just a week or so away, with it really ramping up in about 2 weeks. So we will have a whole lot to talk about in the coming meetings between you and I. So I'm going to let you go for now, but we will check back in next week and maybe do a little earnings preview.
Sounds good. Take care.
Thank you so much, Sean.